Hello, this is Danny Kenny of Financial Planner. A common question that I get is about determining the appropriate asset allocation and how to implement that in your portfolio. So in the description below, I'm going to link to two articles that I wrote for ChooseFI's blog speaking about this exact topic. The first one talks about why investing more conservatively may be better for you, meaning keeping the returns that you've made in the past run of the stock market or really going forward is more important than trying to eke out a little bit additional return. So maybe you lower your stock allocation to 60 or 70% instead of 80 or 90. And yes, you'll earn less on the way up, but you'll also keep more of those returns that you made when the stock market goes down. And one thing to think about there is when you're suffering less of a decline in your portfolio, you're more likely to stick with your allocation. So in that article I go through there, please check it out. The second one is how to determine your ideal asset allocation given your specific circumstances. So the way I approach that with my clients is to look at three different things. The first being the cash needs that you know you'll have from your portfolio. So if you're entering retirement and you know that you're going to have to pull from your portfolio to meet your normal lifestyle needs, that's number one. That's the thing to consider. Or if you're thinking about purchasing a house, a home down payment, or a car down payment or purchase, that's some other areas that you might need cash for. So I like to plan for keeping 8 years of known cash needs in cash or bonds, meaning safety assets. So when stocks go down, a bear market or a correction, these assets are staying flat or potentially rising just a little bit in value. So the idea here is if the stock market goes down, you will never be selling stocks in that downturn to fund your lifestyle or the home down payment or whatever it is. So for example, if you have a $50,000 a year need in retirement, then we know we need 8 years of that, so that's going to be $400,000. If you have $1 million portfolio, that means you can allocate up to $600,000 or 60% in stocks. So that's one element to determining your appropriate allocation. So the second method, or second thing I like to consider is in reviewing a financial plan with a client, we look at what is the required rate of return. So if you know that you only need to achieve a 6% rate of return to meet your goals, why target 8 or 9 or 10% by investing in a higher portion in stocks? That just exposes you to more risk that you don't really need to meet your goals. So maybe we can bring your asset allocation down and target a lower rate of return, but you'll be exposed to less risk in that regard. And finally, I use a risk tolerance questionnaire. So these questionnaires are all over the internet. Vanguard has one, Morningstar has one. I developed my own proprietary one, and I've got, I think, 14 or 15 questions that ask you, experiences in the past in your investing experience, approaches to losing money, how you would feel and whatnot. So that is one portion, and the second portion is a quick one question questionnaire targeting a specific dollar amount that you could tolerate as a loss in your portfolio. So oftentimes people think about percentage losses in their portfolio. I could tolerate a 25% decline. But if I told you you have $1 million and your portfolio is down $250,000, that's definitely something that's different, thinking about the dollars versus the percentage. So I like to ask in dollar terms rather than percentages, and that really strikes a chord with folks that I've spoken with. So those are the three ways that I like to look at to determine an appropriate asset allocation. If you remember, the first one is the cash needs, 8 years of cash needs in safety assets, cash or bonds. The second one is what is your required rate of return to meet your goals. And the third one is in two parts. It's a risk tolerance questionnaire. So those are the things that I recommend. If you want to integrate that into your own planning, go for it. If you'd like to talk to me further about how we could work together to determine the appropriate mix for you, I'd be more than happy to speak with you. Please use the link in the description below to get to my website, or leave a comment or a question. Happy to talk. Once again, my name's Danny Kenny from Financial Planner. Thank you.